Daily spending on coffee and muffins accumulates to a significant weekly expense. Weekly coffee and muffin expenses compound into a substantial monthly expenditure. Over a year, the cumulative cost of daily coffee and muffins represents a considerable financial investment. Consistent weekly investments, even in small amounts, can accumulate significantly over time. Compounding interest allows earnings to generate further earnings, accelerating the growth of the investment. The longer the investment period, the more pronounced the effect of compounding interest becomes. A mother's notebook tracks savings and investments dedicated to long-term family care. Consistent savings and strategic investments yield substantial growth over time, securing future educational opportunities. The notebook serves as a visual testament to the power of financial planning in ensuring a stable and secure future for children's education. The initial step in building a software company involves identifying a specific problem that can be effectively addressed through software solutions. Developing a minimum viable product, MVP, allows for early testing and validation of the core software functionality with real users. Delivering consistent value to customers through continuous improvement and feature enhancements is crucial for long-term success. Delivering more value than you capture is fundamental to wealth creation in business transactions. Value delivery. Exceeding value capture results in positive customer relationships and long-term business growth. Businesses that consistently provide superior value, foster customer loyalty, and generate sustainable competitive advantages. The company's initial growth phase is characterized by a steep upward trajectory in user acquisition and revenue. Sustained focus on core product features and dedicated teamwork drive continuous expansion and market penetration. The culmination of years of hard work and strategic development results in the company's acquisition for billions of dollars. High mortgage payments can create a cycle of debt, trapping individuals in financial obligations. Credit card debt contributes significantly to financial enslavement, limiting financial freedom and opportunities. The cumulative effect of mortgage and credit card debt can lead to a state of financial entrapment. A general rule suggests a mortgage should not exceed 1/3 of an individual's gross income. Exceeding this affordability threshold can lead to financial strain and increased risk of default. Financial planning tools and calculators can help determine a sustainable mortgage amount based on individual income and expenses. High-interest debt can severely impair financial well-being through escalating repayment burdens. The accumulation of high-interest debt can lead to a cycle of borrowing to cover existing obligations. Avoiding high-interest debt is crucial for maintaining long-term financial stability and independence. The inability to afford an item twice highlights the importance of delayed gratification. Delayed gratification involves resisting the temptation of an immediate reward in preference for a later, greater reward. Practicing delayed gratification can lead to improved financial stability and long-term satisfaction. Automated investment setup allows users to prioritize savings by paying themselves first. Users can configure automatic transfers from their checking account to investment accounts on a recurring basis. This strategy helps build wealth consistently by automating the investment process and removing emotional decision-making. Diversification involves spreading investments across various stocks to mitigate risk. Investing in diverse industries further reduces risk by avoiding over-reliance on a single sector. A diversified portfolio aims to balance risk and return by strategically allocating assets. Market fluctuations are a normal part of investing and should be expected. Attempting to time the market by predicting short-term fluctuations is generally ineffective and can lead to losses. Maintaining a long-term investment strategy and staying patient is often more beneficial than trying to time the market. Compound interest allows an investment to grow at an accelerating rate over time. The principle of compound interest involves earning interest on both the initial principal and the accumulated interest from prior periods. Even small, consistent investments can yield substantial returns over long periods due to the power of compounding. Consistency and patience are vital for successful long-term investing. Get-rich-quick schemes often involve high risk and rarely deliver sustainable returns. Sustainable investment strategies prioritize steady growth over short-term gains. Financial discipline enables individuals to make informed choices regarding resource allocation. Strategic investment in entrepreneurial ventures can foster economic growth and innovation. Financial stability provides the capacity to support family members and contribute to their well-being. Saved money can be strategically converted into ownership stakes in various companies. Real estate investments represent another avenue for converting savings into tangible ownership. Investing in ideas and intellectual property can generate passive income through royalties and licensing agreements. Financial freedom allows individuals to allocate time towards activities that hold personal significance. Without financial constraints, time can be invested in personal growth, hobbies, and meaningful relationships. The ability to choose how time is spent enhances overall well-being and life satisfaction. Analyzing personal spending habits is crucial for identifying areas of financial leakage. Small, seemingly insignificant comforts can collectively impede long-term financial goals. Identifying and reducing these expenditures can significantly improve one's financial future. Disciplined financial decisions, when consistently applied, generate long-term financial freedom. Compounding interest accelerates wealth growth, enabling prosperity through reinvestment and strategic allocation. Long-term financial freedom provides security and opportunities for personal and professional growth. Stock prices exhibit fluctuations over short periods, influenced by market sentiment and immediate news. Long-term investment strategies mitigate the impact of short-term market volatility, promoting stable growth. Diversifying investments across various sectors reduces risk and enhances the potential for consistent returns over time. A diversified investment portfolio includes various asset classes to mitigate risk and enhance returns. Stocks represent ownership in companies and offer potential for high growth, but also carry higher risk. Bonds are debt instruments that provide a fixed income stream and are generally less volatile than stocks. The credit card debt cycle often begins with easily accessible credit and impulsive spending habits. High interest rates and minimum payments can trap individuals in a prolonged debt repayment period. Unmanaged credit card debt can negatively impact credit scores, limiting access to future loans and financial opportunities. Budgeting involves tracking income and expenses to manage financial resources effectively. Creating a budget requires categorizing income and expenses to identify areas of surplus or deficit. Maintaining a budget involves regular review and adjustment to align spending with financial goals. An emergency fund is crucial for covering unexpected expenses, providing financial security during unforeseen events. Without an emergency fund, individuals may resort to high-interest loans or credit cards, leading to debt accumulation. Maintaining an emergency fund reduces stress and allows for proactive financial planning rather than reactive crisis management. Retirement planning involves projecting future income and expenses to ensure financial security during retirement. Starting retirement planning early allows for greater accumulation of wealth through compounding interest and investment growth. Diversifying investments and understanding risk tolerance are crucial components of a successful retirement plan. Specific financial goals clearly define what needs to be achieved, such as saving a precise amount for a down payment. Measurable goals allow progress tracking through quantifiable metrics, like monitoring the percentage of the down payment saved each month. Time-bound goals set a clear deadline for achievement, motivating consistent action towards the financial objective. Debt consolidation involves combining multiple debts into a single new loan, often with a lower interest rate. The primary benefit of debt consolidation is simplifying payments into a single monthly bill. Lower interest rates through debt consolidation can lead to reduced overall debt repayment costs. Consistently paying bills on time is crucial for improving credit scores. Reducing overall debt can significantly increase creditworthiness. A lower credit utilization ratio demonstrates responsible credit management. Adequate insurance coverage is crucial for protecting against potential financial losses. Insurance policies provide a financial safety net in the event of unforeseen circumstances. Comprehensive coverage minimizes out-of-pocket expenses and ensures financial stability during crises. Estate planning ensures assets are distributed according to an individual's wishes after their passing. Key components of estate planning include creating a will, establishing trusts, and designating beneficiaries. Proper estate planning minimizes potential legal challenges and ensures efficient asset transfer. Strategic financial planning is essential for minimizing tax liabilities. Tax minimization involves optimizing deductions, credits, and investment strategies. Effective tax planning requires a comprehensive understanding of current tax laws and regulations. Early college savings can significantly reduce the burden of student loan debt. Compounding interest allows early investments to grow substantially over time. Starting early provides more flexibility in choosing investment options and managing risk. Real estate investment involves purchasing properties with the goal of generating income or appreciation. Rental income is generated by leasing properties to tenants, providing a consistent revenue stream for the investor. Successful real estate investment requires careful property selection, financial planning, and market analysis. The initial step involves identifying a viable business idea and conducting thorough market research. Developing a comprehensive business plan, including financial projections and operational strategies, is crucial for securing funding and guiding growth. Sustained growth requires effective marketing, customer relationship management, and continuous adaptation to market changes. Passive income streams include dividends, royalties, and online businesses. Dividends represent a share of a company's profits distributed to its shareholders. Royalties are payments made to owners for the use of their intellectual property or assets. Continuous financial education is crucial for informed decision-making and long-term financial well-being. Ongoing learning helps individuals adapt to evolving financial landscapes and emerging investment opportunities. Financial education empowers individuals to navigate complex financial products and avoid potential pitfalls. Financial advisors provide personalized strategies to help clients achieve specific financial goals. Expert guidance from a financial advisor can lead to better investment decisions and optimize financial planning. Working with a financial advisor offers benefits such as reduced financial stress and increased confidence in achieving long-term security. Charitable giving positively impacts both the giver and the receiver. Giving fosters a sense of purpose and fulfillment in the giver. Receiving charitable support improves the receiver's well-being and quality of life. Regular financial reviews are essential for tracking progress toward financial goals. Financial reviews enable timely adjustments to strategies in response to changing market conditions. Consistent financial reviews help identify potential risks and opportunities for optimization. Opportunity cost represents the potential benefits one misses out on when choosing one alternative over another. Evaluating opportunity costs is crucial for making informed financial decisions. Ignoring opportunity costs can lead to suboptimal resource allocation and reduced overall financial well-being. Inflation reduces the purchasing power of money, meaning each unit of currency buys fewer goods and services. Over time, the same amount of money will afford fewer goods due to the increased prices caused by inflation. The cumulative effect of inflation diminishes the real value of savings and investments. The time value of money states that money available today is worth more than the same amount in the future due to its potential earning capacity. Investing early allows for a longer period of compounding returns, significantly increasing the final value of the investment. Compounding involves earning returns on both the initial investment and the accumulated interest, leading to exponential growth. Financial risk assessment involves identifying potential threats to an organization's financial health. Risk management strategies include mitigation, transfer, acceptance, and avoidance to minimize potential losses. Effective risk management requires continuous monitoring and adaptation to changing market conditions. Economic cycles influence investment strategies and financial planning significantly. During economic expansions, investments in growth stocks and real estate typically yield higher returns. Recessions often necessitate a shift towards safer assets like bonds and defensive stocks to mitigate losses. Investing in global markets provides diversification, reducing overall portfolio risk. Global investments offer exposure to potentially higher growth opportunities in emerging economies. Access to diverse industries and sectors worldwide can enhance investment returns. Sustainable investing involves allocating capital to companies that demonstrate strong environmental, social, and governance (ESG) practices. ESG values provide a framework for assessing a company's impact and long-term sustainability. Aligning investments with ESG values can lead to both positive social impact and long-term financial returns. Technological disruption fundamentally alters how industries operate, impacting traditional business models. Investment strategies must adapt to technological advancements to capitalize on emerging opportunities and mitigate risks. Industries experiencing technological disruption often face increased competition and accelerated innovation cycles. Psychological biases can significantly distort rational financial decision-making. Confirmation bias leads individuals to seek information confirming pre-existing beliefs, ignoring contradictory evidence. Loss aversion causes people to feel the pain of a loss more strongly than the pleasure of an equivalent gain. Creating a financial legacy involves strategic planning to ensure future generations benefit from accumulated assets. Key components of legacy planning include asset allocation, tax optimization, and establishing clear inheritance guidelines. Effective legacy planning safeguards wealth, minimizes tax burdens, and provides financial security for descendants.